to let you sell the property. This will crystallize your loss, but the remaining amount will be an unsecured debt held against you, which is really no different than a credit card. The second thing is to opt for what's called a Section 69 debt settlement arrangement. This is actually a step below personal insolvency, and your house will be better protected. You'll actually be in a better position than you would be if you opted for the full personal insolvency arrangement. So here's what you've got to do. First of all, don't decide that going bankrupt or personally insolvent is the only solution. Instead, speak to your advisor and speak to your bank. Ask them to allow you to sell your house for a loss. This is called a voluntary surrender. From that point, either stick to the payment plan that they come up with or opt for that Section 69 debt settlement arrangement that we just told you about. Then you just have to work your way through the plan and come out the other side. Financial problems are always hard, but you don't need to make your life any harder than it already is. And that's this week's Inside Tip from the world of finance.
God, Carl, you make it sound so easy. Out the other side, no problem.
It is that easy. That's the nice thing about it. A lot of these things that people are always terrified in finance are incredibly simple underneath. And this is no different. You know, if someone is in a situation where they're saying, oh, the bank are going to come after me, I'll have this shortfall left over, we now have legislation that can deal with that. And the important thing that people know is that you don't have to go bankrupt or move to Northern Ireland or, you know, even go for insolvency. It's actually the same kind of process that you use if you had a credit card debt.
And does it work for single homeowners as well?
Well, I suppose the interesting thing about that is that there's going to be people who only own a family home, and where part of their solution is going to be what's called a voluntary surrender. Now, if you had a house worth 200,000 and you owed 100,000 and you sold, the loan would be cleared. You'd actually be left over with money. But for people in negative equity, they're going to be left over with a loss. And I think for them, if they end up losing their family homes, that again, this is ideal. You know, it's a very simple process, and it is one that is not as onerous as insolvency, and because of that, it probably will become the more preferred version of dealing with debts than bankruptcy or the full version of personal insolvency, which everyone is constantly talking about.
How are banks reacting to the suggestion from people, from borrowers, that, you know, you want to sell the house for a loss, or this voluntary surrender?
Well, the banks in many cases are pushing for it, so I think in many cases they're actually pushing for it where it doesn't even make any sense. I've seen two examples in the last month, one with EBS, the other with Ulster Bank, where they were telling customers, you should consider selling your property. The couple with EBS was an older couple, and they absolutely didn't need to sell their house. I thought it was a ridiculous idea because they had short-term debt. That's what their problem was. They should deal with their short-term debt using this kind of arrangement and then pay their mortgage and stay in the home. Instead, the bank was saying, no, sell it. So, you know, the banks are pushing for this kind of thing where people lose the property and it becomes unsecured. The other one with Ulster Bank was where the client, again, had a problem with repaying. We came up with a plan where they'd actually get paid in full, and they still said no. So sometimes the banks don't make any sense, and their solution is sell and just, you know, realise the loss or gain, whatever. You just have to sell.
What can people do in that situation, Carl? We hear so much anecdotal evidence of situations like this, where people come up with what seems on the face of it a perfectly logical plan that the banks should go for, and the banks say to get into an entrenched position. What protection do you have then? What can you do to force the bank to accept what you're offering?
You can't force the bank, because the underlying issue here is all about contract, and contract is held as very sacred in this country, and it's a good thing because it keeps all businesses together and gives us the world that we live in. The thing that I would say, though, is a lot of times people don't realise the rules and the laws surrounding their rights, and that's where people like me who have specialties in compliance come in. So when I see a bank doing something that they shouldn't, I start to examine, are they responding in the amount of time that they should? And then if they're not, I start to tie them up with problems that will cost them thousands of euro. The first thing I do is put in data requests. That's a very expensive process for them, only costs the individual about €6. Next of all, I complain to the Financial Service Ombudsman Office if there's a valid complaint. I'll make an appeal under their mortgage arrears resolution process. And you basically send out 5 or 6 different arrows flying at them, and you put them on the back foot. And I find that's a good way of dealing with them. Unfortunately, with banks, sometimes you've got to beat them up a bit to help them understand, and that's...
I suppose ultimately you shouldn't be taking them on your own without some sort of backup of advice or some sort of...
Well, if you happen to know what you're doing, I don't see why you wouldn't. But a lot of people have normal lives and they're interested in regular things that aren't, you know, the kind of things that I spend my life reading and studying. So if you are one of the nerds out there who likes what I like, then you're perfectly equipped. If you're not, well, then you might need a bit of help. Although I would say your rights exist with or without any assistance. They are, you know, inalienable, and you can do this on your own if you wanted.
Well, let's move on to pensions. This is your area of expertise because my pension is tiny.
Yeah, and mine as well. We're
It was
talking
all
about
over
the mandatory pensions now this week. Good move, or is it something that's going to be resisted? You know, they're talking about keeping people in work even longer, heading towards 70 now.
I think a lot of the debate in this whole area is so insincere. You know, we've seen, for instance, that everybody sitting here today and most of the people at home are going to have to work for longer to get a pension that is worth less. And that's not because you haven't contributed. You're going to contribute more and get a smaller amount later in life when you're going to be closer to being dead and therefore have less time to collect it. You know, so in that respect, what we're doing is we're taking a transfer from young people and giving it to old people. And then people complain about the public sector who have pensions that are just absolutely out of this world good. In some cases, that's like deferred payment, you know, where they don't get as much pay for doing what they're doing. In other cases, they're actually paid more while they work and then they get excellent pensions. And the truth is, they probably need to come down. But what we never do is look at regular people in PAYE jobs and the state pension that they obtain. And you've got people who get a pension that if you valued it is worth €250,000 and they might never have done a day's work in their life. And you have to wonder, like, if we want something that's fair, then what you've got to do is make everybody on identical same principles have the same opportunity, that they all fund into the same type of pension and you do pay into it. For the people who are very poor when they arrive at retirement, fine, we'll have some kinds of mean-tested alternative. And if people in life want to top that up so they have a real juicy retirement, that's fine too. If that's their decision, let them do it. But everything else and all in between, I find is just, I describe it as kind of kabuki theatre where people are, you know, all this outrage, like, oh, this side isn't fair, but we won't talk about the way that our side isn't fair. And it's all just really insincere. We need a universal system where everyone is treated the same. And that's where the concept of equality truly comes in, because it's the equality of opportunity, not the equality of an outcome. If everyone goes in the same, how they end up is their own deal.
But that's something that has to be sort of introduced when people are starting out in their working life, is it not? I mean, for people that are sort of halfway through at this stage.
If you're led by a government that have no backbone, that's precisely the way to do it. If, on the other hand, they said, you know, we realise that things have been wrong in the past, we're going to change it, you could freeze everyone's rights and benefits as they are now and let them have whatever they've earned, say if it's a defined benefit scheme where it's like a percentage of your wage while you're working, that's frozen and you get that when you retire, plus you start afresh with this new one. I don't see why this debate has raged on as long as it has, because the two things that are working against us is the dependency ratio, which means that there'll be fewer people working for the number of retirees, and therefore the money's not going to be there. We have to do something. The second is that we're living longer, so, you know, so again, something has to happen, and the money is simply not going to be there. Like, this pie, no matter what way you cut it, can only feed so many people. So the solution isn't to come up with new, better ways to slice the pie. It's to actually bake more pies or have a bigger one. So and that's the...
We're heading
I love your little analogies, sir.
68 is the compulsory retirement age by the 2028 or something like that. Yeah. Do you foresee it going towards 70, maybe beyond that?
Well, to be honest with you, 40 years ago it was 70, and then we brought it down. When pensions were invented, it was a guy named Bismarck who was the leader of then Prussia, and your retirement date used to be when you died. That's when people retired. There was no such thing as, you know, having money. He introduced this idea of 65. It stayed there. But back then, people used to die when they were 55. Yeah. So we've gotten into this idea that you can retire younger and younger and have more and more money, and that works until it doesn't. And when it doesn't, we're in a situation like we're in now where we have to face some fairly uncomfortable home truths, which are: A, you're going to work for longer. B, you're probably going to get less. And C, you're going to have to contribute something to get what you do have at the end of that. And this requires people saying, wow, I don't think that's fair. Well, the alternative of having nothing also isn't fair. So,
and the upside, Carl, is?
The upside is that if we address this now, we can avoid, you know, something that can be calamitous in the future. And we can avoid turning around to our kids when, you know, they're our age and saying, while I'm in retirement and your tax rate goes to 60%, just be reminded, this could have been avoided. You know, we owe it to them. We've got to do this stuff now so that they don't do the heavy lifting for us.
All right, Carl, as always, for plenty of
thanks. And he says it with a smile on his face as well. Thank you so much.
Now, coming up, how to bankroll your business without actually having to go to the bank. We'll be finding out how crowdfunding is helping small companies expand and prosper. See you in a few minutes.